So, characteristics of equity securities. So, as we've mentioned before, when it comes to equity, you have you basically have common stock. Okay, but there's two classes here that they say common stock, and they're going to say preferred stock as well. But we're going to go through preferred stock a bit later. So when you look at common stock, they have two different types of voting. How can I say voting systems? I'm not talking about the common shares that's got various classes where the one class has got zero voting rights. So let's park that for now. The voting systems that they have is that they've got a cumulative and they've got a statutory one. So the statutory one, if you look at proxies, statutory means for every share you've got one vote per resolution. Okay, so there's 5 resolutions, and you've got one share of the company. You can vote yay or nay for each one of those 5 different proxies or whatever resolutions. In a cumulative voting thing, you can say, listen, I want to aggregate all my votes for this one thing. Okay, I've never come across that in my entire life, but it's in the CFA exam, so so just know the difference. So that's the difference between a statutory and a cumulative thing. Okay, then with regards to the risk of the common stocks, the common shares, you have a callable stock, you have a normal common stock, and you have a puttable common stock. So let me explain the difference. So when it comes to a callable stock, a callable common stock is the highest, I say the highest risk to the investor. Okay, so it's the lowest risk to the company. Now, the reason why that's important is that a callable share essentially it's got 2 components to it. It's a common share and an option attached to it. Okay, and the option owner is the company. So as you said, it gives the company the right. Gives the company the right to repurchase their shares at a pre-specified price called the call price. So in other words, the reason why they say callable is they can call it away from you. Okay, so that's a callable share. The thing that's unfortunate about that is that as soon as this thing starts to run like crazy, they just call it away from you. Okay, and then you're like, oh man, what the hell? Okay, but anyway, that's the one. Okay, the second one is that so then you have a normal common stock, so there's no option attached to it. And then the other one here is the puttable common share, which is the lowest risk to the investor. Because the nice thing here is you decide, hell yeah, I can put it to the company. Okay, so there's a specific price. So let's say, so obviously what happens with a callable share is that the company, the strike price will be higher than the current price, and when it runs, let's say current price is 100, strike price is 120. So if it runs to 150, the company just says, hey, 120, here you go, I'll take my 150 share. Okay. That's the callable share. The puttable share for the investor is a nice thing because let's say it trades at 100, the strike price is 80. So the put gives you as investor the right to sell it back to the company at a pre-specified price, which is a strike price, in this case 80. So if you bought it at 100, it's a puttable common share, the strike price at 80, and it drops to 50, great, you can sell it back at $80. Okay, so your loss is limited. Okay, if they perform, there's no herstart risk. That's actually the counterparty risk. Okay, anyway, put price. Gone through that. Then the other thing that you have is preferred stock. Then you have a variety of different things. Okay, so guys, preferred stock, preference shares, same thing. Okay, so it ranks just from a voting perspective, it ranks below common shares because it doesn't tend to have a vote. Well, it almost never has. It almost never have. You will never have a vote as a preference shareholder, except if it impacts you directly. That's usually when you have a vote. Okay. And when it comes to repayment of capital, when a company is liquidated, the preference share guys get their money before the common share guys. Okay. So you have a cumulative preference share. What does a cumulative preference share do? If the guy doesn't pay a preference dividend this year, it means that he needs to catch it up next year and pay the thing. So that's a cumulative. Non-cumulative means if he doesn't pay this year, you lose out. Okay. Participating preference share means that if the profits are super, super good, you share up in proportion to it. There's a ratio that they work out. Non-participating is normal preference shares because you don't participate in the other thing about the profitability of the company. Convertible preference share is quite cool because that means you can convert into equity, like convertible bonds. The way that guys tend to, um, if you're a VC fund, VC venture capital fund, the way that you would tend to structure the way that you give money to a company would tend to be convertible preference shares. Because of the way that preference dividends are taxed, first of all, which is more beneficial to the VC company, you're going to make it cumulative, so the guy has to catch up eventually when he makes money. And then the last thing is the fact that in case this company goes bankrupt, you get all the stuff. Okay, because you're the, it's called the fulcrum security. You're the guy where the value ends in. Okay. Don't need to go through that too much. Okay, so what's the advantages of a convertible preference share as in from an issuer perspective? First of all, well actually from an investor perspective, sorry, the dividend is higher than that of a common share. As the value of the common share rises, so too does the convertible pref. The more profitable firm, the greater chance it is, and the shares are less risky because of the fact of it's got fixed payments and it stands first in line, well, it's in front of the line when the company is liquidated. Okay, so here we go with high finance, high risk stuff. Same as what I said. Okay, then you have different voting. Sorry guys, any questions before I go on? Okay. Then you have different class and voting rights and so on. So, as I said, with Alphabet, you have A, B, and C class. The one's got all the voting rights, the other one's got no voting rights, the other's just got one per share. Depends on how it's structured. I mean, usually what tends to happen is, and Under Armour, the shoe, the apparel company, they also have the same structure, like A, B, and C and stuff. So the one's got 0 votes. And the interesting thing about this, the one that's got more votes tend to be slightly more expensive than the one that's got 0 votes. Okay. And you might have different rights to equity and capital, etc., etc. Okay. Then distinguish the difference between public and private equity. Guys, we're going to go through a lot of the stuff in alternatives, so I'm going to not spend hectic amount of time on it, but I'm going to just give you a brief idea. So when you look at private equity technically is split into, well, more than two, but the way that I'll try and like to look at it is it's split into two type of segments that's mostly known by the world. The one is LBOs, so leveraged buyouts, and the other one is venture capital. And you have a few other ones as well, management buy-ins and a few other things, but that tends to be the two big segments. So even though it says private equity here and venture capital here, private equity is usually split into VC and LBOs. Okay, now the first thing about LBO, an LBO market, so leverage buyout, what tends to happen, a company goes, it might be listed, or it might not be listed, but it usually is listed, and the companies come, they raise a crap load of, the private equity firm raise a crap load of debt, they buy out the listed company, and then the debt, let's say of the enterprise value, the debt is 90% and the equity is then 10% that they put down. So 90% bank funded, 10% their money. Then as this thing generates cash, it starts to pay off the debt. So it does it's called a debt sweep. So it pays off the debt all the time. And it improves operations as they go on. Okay. Then after 5 years, let's say the thing was R1 billion that they bought it for. So the entire enterprise value, 900 million bank funding, 100 million private, their funding, their equity value funding. After 5 years, they've paid off 400 million of debt. They didn't really improve the operation, but they've done one or two things. But the value of the company, enterprise value, is still R1 billion. They've essentially they've taken that 100 million and they've grown it to 500 million. Okay, that's the essence of how LBO works. Okay, they turn the they also grow the EV value usually, so they improve the operation stuff. But what they tend to do is they just use someone else's money, pay it back, and then once they sell this thing, they've got a crap load of money because they used other people's money. Okay, that's how it works. That's how LBO works. Okay, and then following characteristics. Liquidity is less as a result not being public. Financial disclosure is less. That's fine. Market does not determine the price, done by negotiation. Reporting cost is lower because obviously there's no JAC requirement or anything like that. Corporate governance tends to be weaker. There's greater focus on long term, and large returns can be earned if the private firm is then taken public, especially if you improved it and stuff. Venture capital, Guys, venture capital, everyone knows the story about Facebook and those type of things. That's a classic VC thing. So, what's some of the benefits? Employment, capital formation, technology growth, and those are the different types of finance that's available. Early or seed funding. Um, I mean, these are different types of VC funds. So, seed or startup is like this, doesn't even have a proper product yet, whereas mezzanine finance comes in at the end before it maybe lists. That's the type of thing that it looks like. Buyouts, I just told you exactly what it is, so I don't think we need to go through that. Management buyouts just means that the management does the buyout and not an outside private equity firm. And private investment in public entities just means that the like a private investor just invests in a public entity. It's not, I mean, it's nothing special. You can just read that. But it's usually done at a discount. Okay, then describe the method of investing in non-domestic equities, as in not in the US. So one way you can do it, you can invest directly. So if you think about it, you can open up an interactive brokerage account and you can just invest internationally in different stock exchanges and so on. That's one. The problem with that is you take a lot more risk when it comes to, I mean, you take a bit more risk when it comes to, not necessarily interest rate risk, but definitely currency risk. If you're investing in a company that's trading in whatever, Hong Kong or Australia, whatever, then obviously it's going to be, that currency is going to have a much bigger impact on your return, depending on how you measure the return. The reporting requirements are different. Also, if the rules and regulations is slightly different. Some of those markets are completely closed to foreign investors. I don't know if you, well, it's usually not the case that as a South African, it's highly unlikely that you're going to be able to invest directly into the Indian or the China A share market. It's very difficult to get in there. Okay. Then depository receipts and American depository receipts. Guys, the depository receipt is how it works. Let me just maybe explain how it works. So let me do the ADR, because the ADR is, I mean, these things are very, very similar. So it's essentially, Sasol's got an ADR. Okay, so Sasol is a South African company that's listed on the New York Stock Exchange through an ADR. It's a sponsored ADR program. And how it works is that an investment bank in America owns shares in Sasol, and that shares that they own in Sasol is now linked to this ADR. So it creates a new instrument called an ADR, American Depository Receipts. So every ADR that you buy is linked to one share in Sasol. Does that make sense? Okay, so it manufactures the paper, and so all that it does is it says, listen, I own these shares here. How's it here? I'm going to issue new shares, and that's listed on the New York Stock Exchange, and then the guys can trade that, and it's a one-for-one. It's the same as exchange traded note to a certain extent, like you're buying an ounce of platinum or whatever. So that's an ADR. So you guys can read through that. That's basically, you can still get the dividends and so on. Sometimes you have the voting rights, other times you do not. And there's different structures within it. You can either have a level 1, 2, or 3, which means that either the one is like sponsored by the company, sometimes it's not sponsored by the company, and the investment bank does it on its own, just to investigate to get guys in. Okay. Depository receipts or global depository receipts. An example of that is, so in London, there's a company called, actually not in London, it's in Russia. Russia's got a company called Mail.ru. Mail.ru is, Naspers actually owns a portion in Mail.ru. Mail.ru is a company that does games. It's got a Facebook equivalent. I think it's Facebook equivalent in Russia. Forgot what the thing's name was. But anyway, they've got games and everything. So it's a social network and gaming company. The thing about Mail.ru is they've got a global depository receipt listed in London in USD. I think it's, in USD. So in US dollars. So it's a Russian company earning rubles listed on London's stock exchange in USD. Okay, so that's a global depository receipt. I wish you can read through it, but I just wanted to give you an idea of, like, in a real life example, what it is. Okay, you guys can read through that. That's fine. Deposit receipts traded, pooled. Okay, you guys can read through that. That's self-explanatory. Okay. Compare the risk and return characteristics of different types of equity securities. Okay, so we kind of went through this with regards to the callable and the puttable. Well, so you guys know what the risk profile is. If it's callable, the company can call it away from you. If it's puttable, you can put it to the company. So the puttable one is the lowest risk to you as an investor, where the callable is the highest risk to you as an investor. Okay, that's where this ranking comes into play. Okay. Now, what do you earn in equities? You earn dividends and you earn a capital return. Depending if you're investing in a foreign country, you might get or lose currency returns. Okay, so those are the three returns basically that associated with equities. Where's the preference share thing? Oh, here we go. And then cumulative, preference share option 3, and non-cumulative. Guys, if I look at this thing here, option 3, you can either be cumulative or non-cumulative. You can't be just a preference share. It should be one of the two. Usually if it doesn't say, I would imagine it's going to be non-cumulative. But I think what they mean here is cumulative preference share with some sort of convertible option attached or whatever. So that's the, especially here if there's a convertible attached in this 3 order, then it's definitely very nice for you as an investor. So it's the lowest risk. Okay, that's fine. Explain the role of equity securities in the financing of companies' assets. Okay, very basic. If you issue equity capital, it is for long-term assets. So it's for the long-term operations of the company. It's not for a very quick 1 year or 2 year thing. So what you tend to do is when you issue if you issue equity, the assets and the type of stuff that you need to do need to be long-term in nature. Okay, and that's one reason. The other thing is, why would you want to list? I mean, that's maybe a more of a thing, but the reason you want to list, or the reason why you want to use equity capital, is to incentivize employees. First of all, to stay longer, if you can, or as a compensation. I mean, it happens everywhere basically in the world where you use equity as an incentive, as a carrot, or golden or silver handcuffs, not even golden handcuffs. Listed equity provide, okay, blah blah blah. That's fine. Okay, distinguish between the market value and book value of, okay, guys, market value of equity. So it's the amount of shares in issue times the share price on the JSE, share price on New York Stock Exchange, whatever. So that's the market cap, the market value of a company's equity, not the enterprise value of the equity. The book value of the equity, you have to go to the balance sheet. The balance sheet will tell you what the equity. So the balance sheet is obviously, if you go to the balance sheet, you've got the asset side, and you have, I call it the funding side, but you've got the equity and liabilities. That price of the equity, that is the book value, what the book value tells you. Guys, book value it's completely lost its relevance. I mean, Buffett actually said that also recently, but you could have seen that for how many years, because there's companies that are listed, like Colgate, all these big consumer good companies that have done so much share buybacks have actually got negative book value because they've done so many share buybacks. And because of the way that accounting works, they actually have negative equity value, which is a bit ridiculous if you think about the equation around that. Okay, so that's book value. You guys understand what book value is? Balance sheet, accounting not always good. Okay. ROE, return on equity. Return on equity, the formula is very, very easy. It's your net income divided by your equity, your shareholders' equity. Okay. That's as easy as it comes. If you get an ROE calculation in the exam, say thank you and just do it. Okay. In most cases, the ROE, an increase in ROE is a good thing, but it needs to be looked at carefully. This is because management can increase ROE in a negative manner by reducing purchase of assets, thereby, okay, there's a lot of ways you can change ROE, because you can manipulate it. All that you need to do to increase your ROE is just pay a massive dividend. That's like one way to do it, because all that you do is you pay a massive dividend, the dividend comes out of equity, retained earnings, boom, your denominator drops. Yeah, or you can just buy back. That's another way. Lots of ways. Lots of ways. Okay. Price to book, market price of the book divided by the book value of the stock. Okay, market price of the stock divided by the book value of the stock. That's the price to book. So what does that mean? It means market cap of the company divided by the equity in the balance sheet. That's essentially what it means. Okay, now Important to get to the book value per share. Total assets minus total liabilities gives you the total shareholder earnings, but you have to also take off the preference shares to get to the book value of the equity, and then you have to divide by the number of shares. Okay, that's the formula. A firm with a low PB ratio can be said to be a value stock. A firm with a high PB ratio can be said to be a growth stock. I don't believe that. I think that's bullshit. But for the CFA exam, we can believe it for now. Okay. Okay. I honestly don't believe in that. But anyway, that's my own issue. Required because of the accounting things that I've mentioned before. Okay, required rate of return on equity. Guys, required rate of return on equity essentially is the minimum that you need to be compensated to hold a risky asset. And the way that you determine that is through, you can determine a few ways, but one way you determine it is through the CAPM model, which we're not going to do tonight, I think. But the capital asset pricing model, just to those that are super interested in it, CAPM, so capital asset pricing model, is equal to the risk-free rate. The risk-free rate in the US will be like maybe a 2-year or a 5-year treasury. Let's call it, or 10-year treasury. South Africa 10-year treasury, what is it, like 8.8 or something. So your risk-free rate plus beta of the stock times your equity risk premium. Okay. Just want to explain this ratio a little bit, or this formula. So risk-free rate, this thing is like a government bond of some sort, or a treasury or whatever, depending on your investment horizon. But if it's in the US, then it's maybe like a 2-year treasury thing. So it'll be, if this is in USD, it'll be like 2.5%. Okay, I'm talking about the 2-year now. Plus, the beta is the covariance of the stock regressed against the market, yeah, depending on the market that you're doing it to. So if it's the S&P 500, it's the one stock regressed against the covariance of the market. Okay, so that's the beta. So the beta of the market is 1, because if it co-varies 1-to-1 with itself. Okay, that's important. A stock that's very volatile, that goes up, like if the market is up 5% and the stock is up 20% and vice versa, then the beta will be 4. Okay, that's a bit simplistic the way I say it, but let's say the market is up 1%, the stock is up 2%, and the market is down 1%, stock's down 2%, that means the beta is 2. Okay, and it can be lower as well, but anyway, that's fine. The equity risk premium is the return of the market minus the risk-free rate. That's the equity risk premium. Or alternatively, the expected market return minus the risk-free rate. Now, the important thing about that is it's what you need to be compensated for holding the market instead of just holding cash. That's the difference between the two. So if the market does 10% and if the market does 10% and you can get 2.5% from cash or from this risk-free asset, then the equity risk premium is 7.5. Does everybody understand? Follow that. We're going to go through that later anyway. Yeah, yeah. Yeah, so that's, yeah, so there's a few, yeah, you are right in all those things. The one thing that is more hectic for Celsius is the debt. Because there's also a way that when you start doing this, you need to unlever and relever beta and all that stuff. But yeah, that's exactly the point. Like, it's more risky. So yes, the beta will be higher, but Celsius is technically not listed. It's blue. But anyway, that doesn't besides the point. But guys, equity risk premium, just to put your mind, we're going to go through this later. I just wanted to touch on this quickly. Equity risk premium tends to be in the region of between 4 to 6, maybe 7%. That's usually what it is. So if you use this type of thing quickly for South Africa, your risk-free rate is in the region of about 8.5 to 9%. Let's make it 9 for ease of it being late tonight. Equity risk premium of, let's call it 6%. So what does that mean? That means that to invest in equity, you need 15%. That's your capital asset pricing model used on the market in South Africa. It's very basic what I did now, but there's a lot of numbers behind this. I'm just giving you guys the concept. Okay, so that's your required rate on equity, and we're going to go through that later. So if the expected return on the asset exceeds required return, then we say that the asset is undervalued. And if the asset is expected to generate higher returns than average required of the, well, the point being is that if you need 10% return, it's going to generate 15, which means it's undervalued, you buy it. If you require 10%, it's only going to generate 5%, it's overvalued. Okay, that's a concept. Okay, R is denoted as required rate of return. It can be used interchangeably. Cost of equity, which is that which we worked out here with the capital asset pricing model. And the other one, required rate of return, is the cost of debt. And this is where we're going to go into, you guys are going to go into Miller and Mogliani in capital and corporate finance. And that's where the nice thing about debt is that it is tax deductible, which gives you a tax shield, which makes the cost of debt even more cheap than cost of equity. But we'll go through that later. Okay, you guys, alpha, if you get more value than what's expected, and if the asset is sufficiently priced, the required return is 0. Okay, and that is it for this evening. Guys, is there